Have you ever found yourself in this situation? You're certain a stock is going to rise because all the news is overwhelmingly optimistic, but just a few weeks later, it plummets out of nowhere. Or you buy something on sale, thinking you've saved a lot, only to realize later that you just spent money on something you didn't really need. This isn't a matter of personal stupidity. It's how the human brain works. Daniel Kahneman, the Nobel Prize-winning psychologist, calls it the two systems of thinking. One fast, instinctive, one slow, deliberate. And it's the conflict between these two systems that causes us to repeatedly make mistakes in our finances, at work, and even in the simplest everyday choices. If you want to understand why you often make the wrong decisions and how to gain better control, join me as we explore the 7 biggest lessons from thinking fast and slow. And don't forget to like and follow the channel, because I'll be sharing more books that can help you become a wiser version of yourself. Part 1. Two systems of thinking, fast and slow. Daniel Kahneman opens Thinking Fast and Slow with a simple yet profound idea. The human brain has two systems of thinking, which he calls System 1 and System 2. System 1 is fast thinking, instinctive, automatic, and effortless. It's like your brain's autopilot. When you drive home on a familiar route, you don't have to think much, yet you steer, stop at red lights, and navigate traffic. When you look at a friend's face, you instantly sense whether they're happy or sad without analyzing it. That's System 1 at work. System 2, on the other hand, is slow thinking, deliberate, logical, and effortful. This is when you sit down to tackle the SAT, compare mortgage rates, or plan your retirement portfolio. System 2 is like manual mode, slower, more energy-consuming, but much more precise and controlled. It sounds balanced, but here's the catch. We rely on System 1 far more than we realize. It's quick, easy, and effortless, but that's also why we fall into traps. A classic example for Americans: you go to Target or Costco intending to buy just a few necessities, but you leave with a cart full of items because the deal is too good to pass up. That's System 1 driving impulsive behavior. Or when you see the stock market tanking on Robinhood or Fidelity, fear can push you to sell immediately, even though your rational mind knows markets move in cycles. Again, that's System 1 taking over. Meanwhile, System 2, though more tiring, protects your financial future. It's the moment you open a spreadsheet to track expenses, carefully compare APRs on credit cards, or read a home buying contract before signing. It's hard, sometimes even painful, but this slow, deliberate thinking prevents costly mistakes. Interestingly, the two systems aren't separate. They work together like two traveling companions. One is bold, quick, ready to act. The other, cautious, deliberate, sometimes annoyingly slow. If you only follow System 1, emotions and errors dominate. If you rely solely on System 2, you risk analysis paralysis and indecision. So, what's the takeaway? Learn when to trust your fast instincts and when to hit the brakes and think slow. When facing big decisions, buying a house, investing, choosing a career, let System 2 take the wheel. In emergencies, like slamming on the brakes to avoid an accident, trust System 1. By understanding the difference and balancing both, you can truly control your mind instead of letting it control you. Part 2. Cognitive biases: why we often get it wrong. One of Daniel Kahneman's most important findings is this: the human brain isn't as rational as we like to think. Instead of always making purely logical decisions, we are often influenced by cognitive biases, mental shortcuts created by System 1 that are quick but full of traps. A classic example is availability bias. When you hear about a plane crash on CNN, your first thought might be, flying is dangerous. In reality, the risk of dying in a car accident in the US is dozens of times higher than in a plane crash. But because plane crashes are dramatic and memorable, your brain tricks you into overestimating the risk. Another common bias is the anchoring effect. If a house in your neighborhood is listed at $1 million, that number becomes an anchor in your mind. Even when a similar house is priced at $800,000, you may perceive it as a bargain. even though it might still be overpriced relative to its true value. This is why stores in the US often label items sale $199, originally $399. The original $399 is just an anchor, making you feel like you're saving a lot and nudging you to buy faster. There's also a bias very common in investing: herd mentality. When you see everyone buying tech stocks on Robinhood or jumping into crypto on Coinbase, you might feel compelled to join in, afraid of being left behind. But this FOMO, fear of missing out, often pushes investors to buy up the top and sell at the bottom. These biases don't just exist in finance, they show up in everyday life. You might unconsciously judge someone based on appearance or a first impression rather than digging deeper. Or when recalling a memory, you focus on the ending and forget the process, something Kahneman calls the peak end rule. These biases keep us making mistakes without even realizing it. So, what's the takeaway? Kahneman doesn't suggest we can eliminate cognitive biases entirely. That's impossible because they're hardwired into the brain. But we can become more aware of them and train ourselves to engage System 2 in important decisions. Before buying a house, ask, am I being anchored by the initial number? Before investing, pause and reflect. Do I really believe in the long-term value, or am I just following the crowd? When you learn to recognize biases in your own behavior, you gain better control and make smarter choices with money, work, and personal relationships alike. And that's one of the keys to becoming a truly intelligent thinker.
Part 3. The illusion of understanding and overconfidence. One of the most subtle psychological traps Daniel Kahneman highlights is the illusion of understanding and the illusion of control. People often believe they fully understand the world around them and can predict outcomes, but reality is very different. Consider the US stock market. Looking back at the dot-com bubble of 2000 or the 2008 financial crisis, almost anyone can point to the signs that were there all along. Low interest rates, high leverage, the real estate bubble, inflated tech stocks. But this is hindsight bias. Once events have happened, we convince ourselves that we should have seen it coming. In reality, no one could be certain while it was happening. Alongside the illusion of understanding comes overconfidence. Many Americans believe they are better than average investors, better than average drivers, or better at predicting the market than others. It's a paradox, since not everyone can be above average. But our brains like to inflate our own abilities to feel safe and in control. Take the crypto market as an example. When Bitcoin skyrocketed from $10,000 to $60,000, millions of retail investors on Coinbase believed they had timed the market or had a special strategy. But when the market turned downward, most realized they had no real control. They were simply riding the market wave. The illusion of understanding also appears in everyday life. Many people believe they know why a marriage ended or why a company collapsed. But in reality, these are stories we construct after the fact to make events easier to accept. We don't truly know the cause, yet we label it obvious to reassure ourselves. Kahneman's lesson is clear. Be humble in the face of complexity. Never assume you understand and control everything. Even Wall Street professionals, with teams of analysts and advanced technology, make mistakes all the time. Instead of blind confidence, build strategies based on discipline, diversification, and risk management. The most important thing is to acknowledge your own limits. When you recognize that certainty is an illusion, you become more cautious, patient, and less likely to make hasty decisions, whether in investing, business, or personal life. And that, Kahneman suggests, is the beginning of true wisdom.
Part 4. Risk Assessment and Loss Aversion. One of Daniel Kahneman's most famous findings is that humans fear losses more than they desire gains. In other words, losing $100 hurts twice as much as gaining $100 feels good. This psychological phenomenon is called loss aversion, an obsession with avoiding losses. You can see it everywhere. In investing, many Americans hold on to losing stocks on Robinhood or Fidelity simply because they don't want to realize the loss, hoping the stock will bounce back. They fear facing the reality that they were wrong. The paradox is that holding on too long often leads to even greater losses. Meanwhile, when a small profit appears, they rush to sell to lock it in, rather than letting gains grow. The result? Investment portfolios that are always unbalanced, cutting profits short and letting losses drag on. Loss aversion doesn't just affect finances, it influences everyday decisions too. For example, an employee in New York might stay in a dull, barely livable job because they fear losing current stability, rather than risking a new opportunity. A small business owner in Texas may continue pouring money into a failing project simply to avoid admitting the initial loss. That fear keeps them trapped, instead of allowing them to start fresh in a smarter way. Kahneman points out that our brains are wired to avoid losses more than to pursue opportunities, because in prehistoric times, losses could mean life or death. But in modern society, this bias often leads to poor decisions. So what's the lesson? Learn to separate emotions from decisions, financial or otherwise. In investing, don't let fear of loss drive panic selling in a red market, or make you cling to a depreciated asset. Instead, plan ahead. Set stop-loss levels, target profits, and stick to your rules rather than acting emotionally. In life, remember that sometimes loss isn't failure. It's the tuition fee for bigger opportunities. Losing a job may be the turning point toward a more meaningful career. Losing a relationship may help you find the right person. Ultimately, Kahneman reminds us that the goal isn't to avoid loss at all costs. It's to manage it wisely. When you dare to take calculated risks, you won't be trapped by fear, and you'll have the chance to go further, both in investing and in life. Part 5. Decision-making under uncertainty. One of the biggest challenges in life and finance is making decisions under uncertainty. Kahneman emphasizes that humans like to feel in control, but the truth is most important decisions happen in environments full of unpredictability. Imagine you're considering buying a tech stock on the NASDAQ. The flashing green and red charts on Robinhood or Fidelity make you anxious. You can't be sure whether the stock will rise or fall, and every prediction contains an element of randomness. This is uncertainty. According to Kahneman, people often fall prey to overconfidence, believing they can predict the future and try to find patterns in data, even when those patterns are completely random. A relatable example for Americans: buying a home in San Francisco or Austin. You look at rising home prices over the past few years and convince yourself prices will continue to climb. But real estate markets fluctuate, and no one can be certain. Making decisions based on this false sense of certainty is a classic example of System 1 driving behavior. Kahneman stresses that the best way to make decisions under uncertainty is to rely on principles and probabilities, not emotions. In investing, this means diversifying your portfolio, not betting heavily on a single stock, and planning for the long term. In life, it could mean keeping an emergency fund or having a backup plan when changing jobs or moving. Another key lesson is to recognize risk and accept failure as part of the process. If you join a startup in Silicon Valley, no one can guarantee success, but understanding that failure is natural and learning from it helps you make smarter decisions in the future. Finally, Kahneman emphasizes survival and success don't come from predicting the future accurately. They come from smart risk management and disciplined action. By accepting uncertainty and establishing your own guiding principles, you reduce fear, avoid major mistakes, and increase your chances of better outcomes in investing, career, and life.
Part 6. The influence of emotions and intuition on decisions. Daniel Kahneman emphasizes that emotions and intuition have a powerful impact on our decisions, but they're not always reliable. System 1, the fast, automatic part of the brain, produces instant judgments based on experience and feelings, yet it's also prone to biases and logical errors.
Take the US stock market as an example. When you open an app like Robinhood or E-Trade and see a series of red candles, your heart races and you may panic sell immediately. Conversely, when charts show a steady upward trend in blue, you feel excitement and want to bet bigger. This emotional influence on financial decisions is one of the biggest enemies of investors, according to Kahneman. Emotions also affect life decisions. An employee in New York might rush to accept a high-paying job that doesn't fit simply because they fear missing out, or reject a Harvard scholarship due to social pressure and worry about being far from home. Intuition can help you make quick decisions in familiar situations, but when facing complexity and high risk, it often leads to mistakes. A positive example: NBA or NFL athletes develop intuition through thousands of hours of practice, and it works exceptionally well on the court or field. But applying that same intuition to investing or business can be disastrous. Kahneman emphasizes that intuition is only reliable in areas with clear structure, rapid feedback, and extensive experience. The key takeaway? Don't let emotions control important decisions. Before acting, pause and switch from System 1 to System 2, the slower analytical part of the brain, and carefully consider the data, risks, and consequences. By training yourself to recognize emotional influences and learning to manage them, you'll make wiser decisions, minimize errors, and improve your chances of success in investing, business, and life. Part 7. Group decisions and social influence. Kahneman points out that our decisions are influenced not only by personal emotions, but also by social pressures and group behavior. We often believe we make decisions independently, but in reality, herd behavior causes many people to act alike, sometimes leading to collective mistakes. Imagine watching Bitcoin or tech stocks on Coinbase or NASDAQ. When online communities constantly talk about an unmissable investment opportunity, it's easy to get swept up in the crowd, ignoring fundamental investing principles. From the dot-com bubble in 2000 to meme stocks like GameStop in 2021, this pattern repeats. People act out of FOMO, fear of missing out, rather than logic and data analysis. Social influence also impacts everyday life. An employee in New York might rush to overspend to keep up with friends, or choose a career based on family expectations rather than personal passion. Kahneman emphasizes that recognizing social influence helps you make conscious decisions, stick to principles, and reduce the risk of mistakes. The final lessons from Thinking Fast and Slow are: identify psychological biases, illusions of understanding, overconfidence, loss aversion, emotional influence, and social pressures. Learn to make decisions based on data, principles, and risk management rather than fleeting emotions. Understand that failure and risk are natural parts of life, but wise decision-making helps you move further and achieve better outcomes. By applying these principles, you not only become a smarter investor, but also a wiser decision-maker in every aspect of life. If you found this content valuable, like this video and follow the channel so you won't miss more audiobooks and book summaries designed to improve financial thinking, life decisions, and wealth-building strategies. Good luck on your journey to becoming a smart decision-maker and achieving financial freedom.